U.S. Job growth slowed down in August. There was just a derisory 22,000 jobs added, well below estimates, and the unemployment rate hit its highest since 2021. Now, of course, this comes after President Trump fired the Bureau of Labor Statistics leader after she unexpectedly delivered weak news on spring employment. Let's get a perspective here from Blake Gwinn, head of U.S. rate strategy at RBC Capital Markets. Blake, always great to see you. Thanks very much for joining us. I know, let's get the routine question out of the way. Does this make it a near certainty the Fed cuts rates September 17th?
It certainly seems like the path of least resistance. I think, there might have been a scenario where NFP, a good NFP print, a bit of a bounce back from last month. You go into CPI coming up next week, get a strong CPI print. I think it would have given a little bit more ammo to some of the hawkish-leaning members on the committee. I think without that, it's very hard for them to make a strong case. So it certainly doesn't bolster that. So it certainly seems like the path of least resistance. Markets want it. It's fully priced. The administration clearly wants it. And I just don't think this NFP print really gave any ammo to fight back against that.
But you say, the labor market is not in free fall in the States. You think it's still a low hiring, low firing environment. It's not that terrible.
Yeah, for sure. You're not going to catch me saying this was a good print or that we're in a booming labor market. But it still just seems tepid. I don't see yet, very clear signs or alarm bells that we're tipping into something more problematic. If you pull back a chart of the unemployment rate, 40, 50 years, we're still at very, very low levels. We're at levels that would be consistent with what the CBO says is the kind of natural rate of unemployment. So really nothing problematic there. I think the NFP numbers that we've put a lot of focus on, the very low NFP numbers, my view is that those have been very, very difficult to interpret right now. With what's happening, given the surge in retirements, the crackdown in immigration, NFP numbers, payroll numbers are giving you the net between the supply and the demand for labor. So it's tough to net out. Are we seeing low job creation because companies are really scaling back, or is it partially because there was a huge hiring freeze? Given uncertainty around tariffs, post-Liberation Day, around administrative policies, they're not really hiring new people. And at the same time, you have people leaving jobs because of immigration crackdown, because of retirements. Is that really what we're seeing? I think it's much more that latter case than seeing the economy really starting to tip over into a more problematic deterioration.
I know we get into kind of a hall of mirrors here with rational expectations, et cetera, but you think one reason that the Fed might be inclined to cut is because the market is so determined or so convinced that we will get a reduction?
It gets very circular, but I think, it's tough to say, well, the Fed's going to cut because the market expects it. The market expects it because they think the Fed's going to cut. Very chicken and egg there. But, I do think it makes it easier for the Fed. I just think, when we talk about path of least resistance, when the markets are essentially 100% priced for a cut, you're getting pressure from the administration. I think you needed a decent, at least an on expectations or maybe a little bit of a bounce back from last month. You needed to see that in the payroll data to give the Hawks a little bit more of an argument against that cut or to push back against market pricing. And I just don't think there's a compelling enough case there for them to really make that push for a September pause at this point.
So sorry, you do, because just so I have it straight, and it turns very recursive, all this stuff, but you do think there will be a cut on September 17th, broadly speaking?
It's starting to seem that that's fairly inevitable. I certainly think there's hawkish-leaning members. My own personal view, just looking at the fundamental case for a cut, I think it's questionable. I think if we had this labor data with inflation, if we were seeing core inflation at 1.8, 1.9 and steady, or even at 2.3 and heading lower, if we were in kind of the position we were last summer when inflation was not a problem, this softness in a kind of meh labor market, that would be enough to start cutting. I think when you're looking at inflation, we've got core CPI in the 3-handle range, and it's moving in the wrong direction. You have to be very, very confident, as Waller is, that this is entirely related to tariffs and that it's going to completely disappear in 6 months' time. I think the decision to cut would be a no-brainer. I just personally think that with that inflation problem, it's a lot harder now. And I think there's definitely some committee members on the Fed that agree with me.
What about, would you be a buyer of, say, 30-year U.S. bonds right now? And of course, that's a simplistic question for a person like you, but say, should I buy a 30-year bond right now in the States if I want to be ahead in profit terms, say, 5 years out?
That's a very tough question right now. And I think one of my views on kind of the long end, and part of the reason I would say I would not necessarily want to own long end duration right now, is that I do think there's some very real risks around this kind of Fed independence question. Markets have taken it very sanguine up to this point. I think, the Cook news, that escalation against Fed independence really hasn't driven that much of a market move. But I think if we get some news on that case, if we do see Cook ending up, getting pushed out by the courts, or eventually, the pressure gets so great that she resigns, I do think markets at some point could start pricing in a higher inflation environment. I would also not discount the fact that, when we are cutting into a rising inflation environment, if we get to Q4, if we see Q4 play out like it did in 2024, where inflation really starts to ramp up, the labor markets bounce back, and the Fed's cutting, and you've got these independence questions, those long-run inflation expectations that drive a lot of the 30-year rate, I certainly think you could see those move much higher. So I personally would not be a buyer of 30-year at this point, just given some of those near-term risks.
Blake, thank you very much indeed. Blake Gwinn, head of U.S. rate strategy at RBC Capital Markets.